Prime Life Project International is asking, Oliver, what do you recommend a newcomer? Should he focus on early morning narrow states, originating, I guess you mean elephant moves, whale moves, or just start playing wherever he finds an opportunity? In the beginning, I think that it's okay to work from a smaller list of things. So, for instance, instead of working with all the possible positions, you pick one real key position, like right near the flat 200 period moving average, and you make that your specialty. So for a while, and you say, okay, any power that's moving off the 200 in the morning, that's going to be my play, or moving down powerfully off the 200 like that. That's going to be my play. So that can be your go-to play in the morning, and also with the narrow Fab 4 states. And guys, if these things are strange to you, you should go to my master classes, which cover all of these things. It's absolutely free right here on the channel. And all of these concepts you'll understand. I've used my master classes to go over almost all of them. I would say that the key thing for a beginner to get right is to make sure that you are playing something that is originating near something else. So if you're playing an elephant bar, make sure that the origin point of that elephant bar, that bar is starting from or near a 200 or from or near a 20. It's not that far. I'm not talking about the bar itself, the beginning of the bar. Is the beginning of the bar near something? Is it near the 20 period moving average? Is it near the 200 period moving average? And if it's near the 20 period moving average, are you playing the bar in the same direction as the 20 period moving average? So if the 20 period moving average is rising, you should be playing a green bar. If the 20 period moving average is declining, you should be playing a red bar that is originating near that declining 20 period moving average. If you can get that main concept solid and right as you begin, all right, I think you're off to the races in a very, very fine way. All right. It's positioning is the thing that I find it's most difficult for beginners to get. They kind of get the bars, but then I'm like, but all right, but this bar is not in a great position. But it's an elephant bar, Oliver. And I said, well, it's not just an elephant bar. It's got to be in the right position. All right. So if you can get that, the bar originates from around something. It's originating near something, not far away from it. And then I think you're good. That's not the only thing. There are plays that are great away, but if you start there, I think you're starting at a great. All right, now look at this. So this was a play for some of my traders this morning, right? Now look what they did, guys. They bought this bar. Boom, they jumped in that bar right there. That's called a clearing elephant bar. All right, boom. Now, go to the beginning, the origin of that bar. Go to the origin of that bar. You see the origin? It started right there. Look at how the origin is right near the 20 period moving average. Okay? That's what you want. You want power that is originating near an item. Okay? Now, go to this one and go to the origin of the bar. The origin is far from the 20. That's not a buy one. That's a sell one. This is a sell bar. This is a buy bar. The buy bars are near something. The sell bars are away from everything. Another one that was played was NVIDIA this morning. So here, boom. Look at the origin. All right. And this is a sell bar because the origin is far. Anytime you get a fat bar with the origin not close, that's a bar you sell. But when you have a fat bar that's originating, starting from something strong, like some strong position like the 200 or the 20, all right, you're going to continue. Even this fat red bar, look, go to the origin. It's the origin is the 200. So it's probably going lower. That's what I'm talking about. Johnny, the Revelator, is asking, does anybody wait until the stock is oversold on the RSI, then buy? Well, not specifically. All right, we don't specifically use the RSI, but we do use an oversold. We do use the oversold concept. And let me see if I can show you this, right? So let me show you what an oversold concept is, right? Here, this blue line is the 20 period simple moving average. And what you can look at with relative ease is you can see a consistent pattern of space on top of the 20 and space on the bottom of the 20. Let me show you this. So look at the space between your stock, all right, and the 20. See that space? Boom. Now look at the space below the 20. Look at the space above the 20. Look at the space below the 20. And what you'll find a lot of times is that there's a consistent pattern to it. All right? There's a consistent pattern. When you get a certain deviation above and or a certain deviation below, you're either overbought or oversold. So I'm always telling my traders, you don't enter something with a lot of space between it and the 20. You don't enter away from the 20. You see? You don't make entries away from the 20. And if you were looking at an RSI, it would be like at the top like that. All right? But what you can do is also mark where things are oversold from a space concept as well. All right? And here. You see? So these spaces are kind of similar. And you can do that with every single stock. We use that. So if we're deep below a 20 period moving average, but also on support. So let's say, look, let's do support here, right? If I were to do price support here, if I get down to this price area, if my stock gets down to this price area, now I've got distance from the 20, I'm oversold, and I've got supportive help from prior lows. If I get a powerful green there that wipes out some red, I'm piling into that. There is a common saying of mine that I am constantly reminding my traders of. Financial items can get far away from their 20 period moving average. They just can't stay far away. So they can get far, but they can't stay far. They have to snap back. And they can get far above, but they can't stay there. They've got to drop back. It can get far below the 20. They just can't stay there. It's got to snap back. So the 20 period moving average is like the vertebrae of the stock. It's the backbone. All right? It keeps the stock in check. Like a leash on a dog. It lets it go ahead of it and behind it sometimes. But there's only so much leash there before the 20 yanks the stock back toward it. There are too many traders that try this with this feeling as though I have to do it with my money, and they destroy their families' lives. They destroy their savings. They destroy their future. They hurt themselves because the first period of this is loss, traders. You cannot get around this. Do you understand? You can't get around the fact that you're going to lose first. You have to lose your life before you gain your life in this business. You have to squat before you leap. Do you understand? You got to go backwards before you go forward. And God help you if for whatever reason you are not trained, you are not disciplined, you have very little experience, and you start winning right away. God have mercy on your soul, because I am telling you, if that happens to you, the market is going to correct that. And it is going to take back what you weren't supposed to have, what you did not earn. And it's going to take it back so violently that you probably won't ever rebound from that. You don't want to win first. Winning, or true winning in this business, comes after the hardship. True, real winning comes after experience. It takes time to build experience. It takes time to go through every possible scenario the market can throw at you. It takes time to live through all of the different market cycles. It takes time to go through and live through and experience all of the market's possibilities, all of the things, all of the tricks that it has under its belt, all of the things that it has the possibility of throwing at you. You have to work to get to a place in your development where the market can no longer surprise you. Do you understand? Where it's impossible for the market to surprise you, because there's nothing that the market can do now that you haven't seen hundreds, if not thousands of times. You've got to remove the element of surprise. You've got to get yourself to a place where, been there, done that 1,000 times. And this state removes fear to a large extent, because if you've seen it 1,000,000 times and you've been through it 1,000 times and you're still alive, then it can't be that serious, right? And so your goal should be to rush for experience, not rush to be profitable right now. Rush to get experience. To become experienced, you need thousands of winning trades and thousands of losing trades too. Why do that with your own capital? Why lose when you know, in order to become experienced, I've got to lose a lot and win a lot. I've got to put losing behind me. So if that's the case and you know that, why would you lose your own money going through that period? Bring your money into the equation after this period, after you've got all the losing out of the way. My father used to say, Oliver, look, I never really agreed with my dad's philosophy, but he did. It was just always interesting when he said it anyway. He would say, Oliver, listen, my theory is that everyone is born with the same amount of bullshit they have to go through, bad times in life. Everyone has the same amount. He just says that some people experience all of their bull in life, all of their bad things in the beginning of their life. And having gone through it very early, it looks as though now, in the middle of their life, at the latter part of their life, they live the charmed life. Almost everything they touch turns to gold. Nothing really bad happens to them. That's because they got it out of the way early. Some people don't experience their bull up front. They experience it in the latter part of their life. And the beginning of their life seems to just be peachy. until later, when it's time for them to experience their lot in life, their lot of bull in life. And some people experience it in the middle, and some people just get it sprinkled throughout their whole life. But my dad's theory was that everyone has the same amount. It just looks different because they experience it at different times. If that's true, it is preferable for a trader to get all of his losing out of the way now. Don't delay it. Don't try to escape it. Just, if you're going to lose, if that's required to become truly a master, if losing 1,000 different ways is required to become experienced, to become decorated as a trading soldier, then get it out of the way now. Let's just lose until it loses your grip on you. Don't delay it. Don't hold it back. Don't get depressed. Don't get bothered. Don't get down on yourself. Just keep going, because at a certain point, losing runs out of its ability to surprise you. Losing runs out of its ability to hold you, because you've seen it so often. You've seen it so many times. You've experienced it so many times. And it starts to get easier to chop the losses down, to minimize them, to keep them under control, especially when you're familiar with all of the ways to lose. But that familiarity can't come from a theoretical understanding of loss. You've got to lose first. And I wish this was told to me when I was going through my 6 years of darkness, living with deep depression. If someone was there to tell me, Oliver, this is the way it's supposed to be, it would have been easier for me. Oliver, what do you do when you lose so many times and you have anxiety to do it again? How do you deal with that? If it's not your money, it's easier. All right, that's number one. You're not losing your life. You're not losing your money. There's still some psychological pressure there because you want your record to be good, but it's not a financial destruction that you're bringing about for yourself. You've got to understand, Arona, you've got to find a way to start using your losses so that they stop being something that you get afraid of doing, and you start to realize these losses are making me better. And this takes journaling your losses, categorizing your losses. If you've got 4 techniques that you play, all right, now you're going to lose on all 4, but which one do you lose the most with? This one produces my biggest losses. This one produces my most frequent losses, but they're small. This is very important data, Arona. All right. So now this one, I have the smallest amount of losses and therefore the best gains. So I'm going to accentuate this one, minimize this. I'm going to minimize this one and eliminate this one. What is out of all the losses you had last week, you add up all of the losses you had, and you divide the total amount that you lost by the number of losing trades. That gets you your average loss per trade. How many traders do you know that can tell you on the spot what last week's average loss per trade was? Probably 0. No professional trader walks around not knowing what their average loss per trade is. Because then how do you make, if you don't know your average loss per trade from last week, how do you make this week better? How do you know you're losing correctly? Because if that average loss is too big, this week must be dedicated to shrinking it. And that takes focus. It takes a focused outlook every single trade. Your focus is not next week to make money. Your focus is to lose less, to make every losing trade smaller to get that average down. But it has to be done focusedly, in a focused way. Every week needs a goal. You should, excuse me, guys, you should not be moving into the next week just saying, okay, I hope this week is better than last week. Like it's going to freaking fall from the sky without some plan, without something to focus on Monday through Friday, something new, something to tweak, something to change, something to improve. You can't just roll from one trade to the next thinking that one day is just going to magically get better, I guess. So life doesn't work that way. Your losses are your stepping stone to your future. Your winning trades are inside of the losing trades, traders. You've got to crack those babies open. What part of the day do you lose the most? Is it the morning? Is it the open? Is it right after the open? Is it in the middle of the day? Is it in the end of the day? What stock is responsible for the vast majority of your losses? Which tactic is responsible for the vast majority of your losses? What day do you trade the best of the week? What day do you trade the worst of the week? Do you follow what I'm saying? I'm getting another error message. I hate this. My God, what is going on? But traders, learn to embrace your losses, okay? Learn to embrace your losses. I'm getting the same error message, guys. I hope we don't start. Learn to embrace your losses. Learn to use them. They are your angels. They point the way. Your losses are like pain in the body, which is not pleasant, but the pain is sending you an important message. Listen, don't put your finger on the fire. Right? Don't touch the sharp glass. Do you understand what I'm saying? You know, if you bump your head up against the wall like this and you get hurt, it's like, okay, don't move that far next time. Losses help us tweak our game. They are our messengers. Don't be afraid of them. Let's get them all out of the way. Let's do it now. Why deal with it in the future? Why delay it? Let's become chronic losers right now. So we can get on the other side of this now. John is asking me, Oliver, what do you mean by a 2 push target and a 3 push target? I teach my traders to take profits after 2 or 3 pushes, preferably 3 pushes. And a push to me is just a sudden velocity in your P&L. All right. So a velocity in your P&L means that your P&L speeds up. Like you see your money just, that would be 1 push. But a crawl penny by penny is not a push, even though your profits are rising. So it's all about the velocity of a sudden move. All right. So your stock could be trading at a certain pace, making you some money slowly, and then all of a sudden, that's 1 push. It just sped up. So a push is more of a velocity in your P&L. The velocity changes. The rate of movement picks up. All right. And if that's too vague, just use solid bars. A nice solid bar is 1 push. Another solid bar is another push. A little bar, even if it's in your favor, is not a push. A nice push, a swing. All right. If I had to give a push a sound, that's what it would sound like. Like this is not a push. That's not a push, right? A push is trading properly comes down to basically monitoring risk. Do you know why? You know why the risk side and not the profit side is the most important side? Because the profit side happens all by itself. Like, if you buy a stock at $40 and it goes to $43, what did you do except pray? Nothing. You didn't contribute to it. You didn't throw any extra money out there. You didn't call up a billionaire friend and say, buy 100,000 shares of the stock so you can push it higher for me. You did nothing but sat there with sweaty palms, elephants dancing up and down your stomach, not even butterflies, elephants, while you were praying. But you did nothing to contribute. But that's not the case on the losing side. The losing side is all you, because the market can't stop itself. Please understand this. The market can't say, all right, I've had enough. This is enough. You've lost enough. I'm not moving anymore. We're done. The market doesn't do that. So because the market doesn't have brakes, because the market can't stop itself, it needs you to stop it. It doesn't need you to make money. It needs you to stop it when something's not right. It needs you to halt the game when you're losing too much. So in a sense, trading is like a partnership between you and the stock. The stock says, okay, I've got the profit side, but look, I'm going to go out there and I'm going to do my best to try to make profits. But if the environment's too strong for me, will you save me? I'm trusting you. I'm placing my life in your hands. I can't stop myself. I need you to stop me. I will take care of the profit side if I can. But if I can't, please save me. And that's real proper trading, which is why your most important role is not the winning side. That is the market's job. Your role is to take care of the losing side. And I promise you, just by mathematical certainty, you're going to have the winning side. It is actually the controlling of the losing side that creates the winning side. It's not the reverse. You understand? Just by mistake, you're going to find winners. Just by luck, you're going to find winners. Just by chance, you're going to fall into a winner. You don't even have to be skillful. But if you're skillful at keeping losses small, wow. Watch those wins start piling up automatically. Your progress is going to come in patches initially. So it's almost going to be like the light bulb turns on and you're going to feel like, wow, I finally got it. And that light bulb is on for a period and then the light bulb dims and goes out again. And you're going to be like, where did it go? But that's okay. If you keep focused on keeping your losses under control, finding relatively low risk plays in good position, just doing the right thing, even if you're losing doing the right thing, don't worry, that light will come back, I promise you. And then it will stay on for a period and then go out again. Now, what will happen over time is that you'll find that the length of no light will start to get shorter, and the period during which you feel the light gets slightly longer. You'll start to see that the quality of the light will actually start to improve too. So not only is it a good period, but the quality of the period will start to go up. They'll reach a point where there's more time with light than there is darkness. And there will be a time when there will be dim light, break even, bright light, really profitable, medium light, good, and small darkness when it happens, only to give way to light again. And so this is good because I had no light. It was just straight darkness for me. Now, I find it very encouraging that most people don't experience it the way I experienced it, that they experience it the way you experience it, Santiago, where you get glimpses of your future. You get glimpses of who you're going to be. You get glimpses of that finer, better, more disciplined trader, and it goes away, but that's life giving you a glimpse into the future. Don't stop. Don't get discouraged. Just focus on being true. Sometimes, traders, in life, you've got to do the right thing, even if the results aren't great, by doing the right thing. But the fact that the results are not great should not influence you to stop doing the right thing. And so once you know what the right thing is, your only job is to keep doing the right thing, even in the face of just losing. As long as you can be sure I'm doing it correctly, it won't stay like that. The right thing will ultimately overcome, but you can't stop. And you can't trick yourself if you're not doing the right thing and pretend that you are. That doesn't work either, of course. But once you know what the right thing is, then it can't be about results. There is this weird, strange dichotomy that takes place during every trader's development. That is that I feel I'm getting smarter, but my account says I'm getting dumber. How is that? How am I better than I've ever been? How am I more knowledgeable than I've ever been? How am I more experienced than I've ever been? How am I more intelligent as a trader than I've ever been, but my account is worse than it's ever been? How is that? That is freaking normal. And granted, it's responsible for the biggest part of the trader's cemetery. There are more tombs with trader's epitaph written on them because of that than anything else. But it's a period you have to just keep plodding through. And it's easy to do that when you're not losing your own money. Ark is asking, Ark's one of my traders here, the first bar of the day, St. Oliver, if the first bar of the day is an elephant bar at the 200 period moving average, can I get into it early, like right after the first minute versus waiting a little bit longer, like a minute and 40 seconds? So Ark's assuming a 2-minute bar, and he's asking, if we've got this strong elephant bar being born from the 200, can I get into the bar right after the first minute instead of waiting like a minute and 40 seconds? Can I get in a little earlier? When you get into it right at 1 minute, you still have another minute for that bar's nature to change. I want you striking that bar when you know with certainty that there's not enough time left in the bar to change its nature. You understand? So a full minute is still a lot of time. I mean, well, of course, it took 1 full minute to produce what you liked. Another minute can reverse what you like, but maybe not 20 seconds. So in today's environment right now, I would want that extra certainty, all right, where I know there's not enough time left in this bar for it to radically change what it's done. Salil is asking Oliver, sir, do you think after the first 30 minutes of the market, a 2-push target is more probable than a 3-push target? Sometimes. Yeah. But it does depend. It depends on the market environment. It depends on whether your stock that day is in play or the sector that your stock is in play, these things can have an impact. So the environment in the market overall, whether or not your stock or the sector your stock is in play, and that sector's being driven right now. And so these things can have an effect. But here's something interesting. As you start to trade bigger and bigger size, this goes away, because when you're trading bigger size, you take profits on every push. You don't have any pushes that you ride. So when you trade smaller size, you should have some pushes that you sit back, relax, and let the market ride you to a point to take profits. But when you have a lot of size, you can't afford to be top heavy with your size. So you have to almost immediately start chopping your size down. So every push you're selling, every push you're selling, every push you're selling. And if there's a reversal, at least the stock's reversing on you with a much lighter stash than a very heavy stash. And so I work my traders back from 3 pushes plus to 2 pushes plus to 1 push plus to immediately start taking profits, then 1 push, then 2 push, then 3 push. So I think that's something interesting. Also, I will say this: some stocks are just 2 push stocks, and some stocks are 3 push stocks. Like I took a trade this morning in Nvidia. Nvidia is a 3 push stock. All right, you're shortchanging yourself if you're taking 1 and 2 pushes. All right. But something like, I don't know, what's something? Wells Fargo might be a better 2 push stock. All right. So it depends on the stock as well. When in doubt, do both. Take part on 2 push, another part on a 3rd push. Okay, Ricardo is saying, Oliver, it's been more than a year that I'm a student in your program. Cool. All right. Still a baby, but awesome. You've lasted a year so far. And I'm going to be attending your summer program in Barcelona. I'm looking forward to that. I'll be in Barcelona this summer. And I want to get started. What are the steps that I should take? Well, the first thing is just to be there. All right. Continue to do what you're doing. Now, what we're going to be doing in Barcelona is we're going to specifically carve out the first 20 minutes of trading. And I am going to drill down deep into virtually everything you need to do to make the first 20 minutes of trading sufficient to make a living for yourself. This was my specialty on Wall Street, guys. I had this unique specialty of being able to make good money in the first 20 minutes of the trading day before many traders even made their first selection. And this was not common back in the mid-1980s, late 1980s. In fact, it was considered a sacrilege to place a trade inside of the first 15 minutes of trading. That most traders sat there even as long as 30 minutes watching the money flow and trying to determine whether who was in control of the balance of power that morning. Was it the bulls or was it the bears? And it was common practice to sip coffee and basically stare at your screens for the first 15 to 30 minutes. I started this brand new approach that captured the attention of so many traders that my firm wanted me to start teaching the approach to other traders. And then other firms asked my firm for permission to send me to teach some of their traders. And this is what gave me the idea years later that I can do this from my own firm. It's what gave me the idea to start my own training and educational firm, initially for professional traders and later for retail-oriented traders that were just like me, had a passion and wanted to try their hand at doing this for a living. But what we're going to be covering is we're going to be carving out that first 20 minutes. I want every single one of my traders to have that 20-minute skill. It doesn't mean that you stop trading after 20 minutes if you don't want to, but I don't want you to have to. All right. I want every one of my traders to have that 20-minute skill and that all morning skill too, and that all day skill if that's what floats your boat. All right. There are some good days you might want to just keep pounding away, some good runaway trending days. But I want you to have that 20 minutes, and that's what we're going to focus on. And we will focus on that 11 weeks in a row. And that's what that live trading camp program is all about. I'll talk to you about that toward the end of our Q&A session today. But I'm going to have you for 11 weeks drilling this 20-minute period until you have it, until it's, coming out of your ears, if you will. Any reason why you don't trade Bitcoin like you day trade Apple? All right. First of all, yes, I do not. For those of you who are curious about this, I do not trade Bitcoin. I don't really trade the cryptocurrency market. I believe that the market is still relatively young. It is not truly appropriate for short-term oriented trading. Not that there can't be moments where you can do it, but it is not mature enough for short-term oriented trading the way I do with the equity markets. All right. Oftentimes it's very thin. It's very manipulated at certain moments by the activity in the futures contracts. It's a lot more unreliable in the very short term. You see, Bitcoin's reliability is over a 4-year period. Never has Bitcoin failed an individual who was willing to give it 4 years. It is a savings mechanism. It is a wealth building mechanism. It is not right now an income producing mechanism. All right. So I use trading the equities to generate income. And if that income supersedes what I need for a good life, I take the excess and move that to the wealth side of my program. And a lot of people think that you need to make a choice in this business as to whether or not you should be an income producing market player or a wealth producing market player. To me, that is the wrong approach. You need both sides of the coin. You need income producing every day, and you need to be working on not only generating wealth for yourself, which goes far beyond income. We're talking about generational wealth, wealth that you leave from one generation to the other, wealth that affects people in your bloodline that aren't even born yet. I mean, this is the impact that you should be trying to make in your life and for your bloodline. All right. Generational wealth. And the first goal is income. You can't start wealth first. So you have to start working on income producing. And when you get to the point where your income trading, your short-term oriented trading, let's say, as a trader, is sufficient to take care of your life, then the next phase is to start producing a portion of income that goes beyond your needs. So, if you start to make 150% more than what you need, you're going to take that excess and now start dedicating that to a longer term approach to the markets. The crypto market is not yet ready for consistency in that area. It's often very lightly traded, especially when you get outside of Bitcoin. It's very thinly traded, and any market that's thinly traded is more subject to short-term price manipulation by the whales, by the futures contract players. All right. There are things such as spoofing that goes on all the time in the crypto space, where you see a whole bunch of bids that have no intentions of being filled, or a whole bunch of sell orders start piling up at a certain price to give you the impression that there's this huge sell wall, and it's fake, meaning that the players are just playing with the novice market players who are reacting to every little thing. All right, so I'm not saying that there aren't moments you can do it, but it's not time for that yet in that market. There are far better, more superior things to trade for consistent profitability than in the crypto market right now. All right, it's still a baby. It's still a baby.